Is the electric vehicle maker, NIO, finally breaking out from this brutal multi-year falling trend with a historic profitability milestone? Or are retail traders staring at these aggressive buy signals, thinking they found the bottom, while actually walking right into a massive, heavily disguised value trap?
Yeah, I mean, that is the multi-billion-dollar question when you look at the tape today, because on the surface, the latest news headlines are just glowing.
Right.
But you look under the hood at the cash flow and you start wondering how long the engine can actually keep running before it needs a massive dilutive overhaul.
Well, welcome to today's deep dive. We have a massive stack of fresh data to get through as of today, April 13th, 2026. We've got NIO's full year 2025 financials. We've got breaking technical signals on the chart and some wildly aggressive options order flow to look at.
It's a lot of data to unpack for sure.
It is. And our mission today is to really tear apart this fierce bull versus bear debate and figure out the mechanics of what is actually happening beneath the surface of this stock. Now, if you enjoy how we break this down, you must like the video, subscribe to our YouTube channel, and honestly, it is absolutely compulsory to leave your feedback in the comments. We really want to hear your take on this.
Definitely. And, before we get into the heavy numbers, let's just set the ground rules for everyone listening. This is a natural intellectual debate exploring the source material and the financial data we've gathered.
Exactly.
We are analyzing the mechanics of the market and the differing viewpoints out there. Absolutely zero financial advice is being given here.
Completely. We are just here to figure out how these market forces work, not to manage your portfolio. So let's jump right in. The headline-making waves across the trading desks today, NIO, is trading at $6.46 intraday.
Yep.
And it is riding this wave of short-term bullish momentum off a historic fourth quarter report. I mean, they just posted their first ever quarterly GAAP profit of 282.7 million RMB.
And we really need to pause on that acronym, GAAP. It stands for Generally Accepted Accounting Principles. The reason the market reacted so violently to this is that, well, a GAAP profit means this is real, strictly measured accounting profit.
It's not just some adjusted metric.
Exactly. It's not adjusted EBITDA, where a company conveniently ignores stock-based compensation or depreciation just to make the numbers look pretty. A GAAP profit is a very high bar for an expanding EV company. It's a massive psychological barrier to cross.
Yeah, I definitely get the psychological win. But if I'm looking at this critically, it feels a bit like a startup that finally manages to make a $1 profit on a single unit after years of burning cash.
Sure, I see where you're going with that.
Like everyone pops the champagne, but the structural costs are still there, right? Does one strictly measured profitable quarter actually fix a fundamentally expensive manufacturing machine?
Well, to answer that, you have to zoom out from the quarterly snapshot and look at the full year 2025 income statement. And the operational improvement is undeniably real.
Okay, let's look at the annuals.
So total revenue was up 33.1% year over year to $12.51 billion. That's about 87.49 billion RMB. And the gross profit jumped 83.5%, pulling their gross margin up to 13.6%.
Okay, so a gross margin at 13.6% means that for every $100 they spend actually building the physical cars, they keep about $13.60.
Precisely.
And that's before paying for all the corporate overhead, the research, the showrooms, and everything else, right?
Right, exactly. And in an environment where battery costs fluctuate and competitors are constantly adjusting prices, expanding your gross margin, by that much means your factories are getting highly efficient.
So they're building them cheaper.
Yeah, you are stamping out cars faster with less waste and amortizing your fixed costs over a larger number of vehicles. And because of that efficiency, their net loss for the year was reduced significantly down to $2.14 billion or 14.94 billion RMB from the previous year's massive bleed.
But wait, hold on, because this is where the narrative completely fractures for me. You just said they reduced their net loss to over $2 billion.
Yeah.
So they are still losing billions annually. I mean, when you turn the page from the income statement, which shows revenue and margins, over to the balance sheet and the cash flow statement, the math gets terrifying.
Oh, the balance sheet is definitely where the structural anxiety lives.
Right, because the data shows they hold $6.6 billion in cash. And on paper, 6.6 billion sounds like a massive runway.
It does sound like a lot.
But their current liabilities, which sit at 78.6 billion Chinese yuan, actually exceed their current assets of 76.6 billion yuan. Plus, their operating and free cash flow remained completely negative for the entire year. Free cash flow is estimated at a negative 17 billion yuan.
Yeah, it's a tough spot.
If they have billions in cash, why are the liabilities outpacing the assets?
Think of it like running an incredibly popular restaurant. Every table is booked, the gross margin on the food is improving, and the cash register is ringing constantly. That's your income statement.
Okay, makes sense.
But the rent on the building is astronomical, your lawns are coming due, and the cost of upgrading the kitchen is bleeding you dry. So even though you have a big pile of cash in the safe right now, the bills you are legally obligated to pay over the next 12 months, your current liabilities, are larger than the cash and liquid assets you have on hand.
Wow. So despite selling more cars, cash is physically leaving the building faster than it's coming in.
Exactly. That is negative free cash flow. You are basically operating on a treadmill, and the treadmill is moving just a fraction faster than your legs can carry you.
Which brings us to a massive contradiction. I mean, if the balance sheet is sitting on that kind of severe liquidity risk, why is the stock chart flashing green?
Well, the market doesn't always care about last year's balance sheet.
Right, because the stock is currently at $6.46. It's sitting comfortably inside its 52-week range of $3.34 on the low end to $8.02 on the high end. But the market is reacting aggressively to the upside. How are the technical indicators completely ignoring the cash burn we just talked about?
Because the market is a forward-looking, momentum-driven mechanism. Technical traders aren't looking at the free cash flow from last year. They are looking at price action and algorithmic signals today.
So they're just trading the trend.
Exactly. And the trend direction right now is undeniably bullish in the short term. The stock is currently trading above its 50-day moving average, which is at $5.34. And crucially, it's above its 200-day moving average at $5.53.
Which sets up what technical analysts call a
golden cross.
Right, a golden cross is when the short-term 50-day average crosses up and over the long-term 200-day average.
Yep.
But, I mean, why does a line crossing another line on a chart actually make the price go up? Is it just a self-fulfilling prophecy?
In many ways, yes, it kind of is. It's a mathematical signal that short-term buying pressure has overwhelmed long-term stagnation. When that cross happens, massive institutional trading algorithms are programmed to automatically start buying.
Oh, wow. So robots are just buying the signal.
Pretty much. It signals a regime change in the stock from a downtrend to an uptrend, which brings in a flood of automated liquidity.
And we are seeing that liquidity flood into the options market as well. I mean, the source data shows wildly aggressive order flow. Call option volume is way above normal, and it is heavily directional toward the upside.
Yeah, and call options give the buyer the right to purchase the stock at a specific higher price in the future. When you see massive volume here, it means traders aren't just buying the stock. They are using leverage to bet heavily that the price is going to spike.
And mechanically, when traders buy all those call options, the market makers who sell them have to go out and buy the underlying stock to hedge their own risk, right?
Exactly, which artificially pushes the stock price even higher.
So you have algos buying the golden cross and market makers buying to hedge the options activity. That explains the short-term strength and momentum. It also fuels the narrative on retail platforms that the stock is currently a steal.
Yeah, you see that undervalued narrative a lot right now.
Right. Simply Wallsane, for example, is estimating the stock is roughly 20% undervalued based on their cash flow models.
And value investors see a stock that was once trading much higher, see that 20% fundamental discount, see the new GAAP profit, and they just believe they're getting in at the ground floor of a turnaround.
I am incredibly skeptical of that undervalued label right now. I mean, look at the momentum indicators.
You're talking about the RSI.
Yeah, the relative strength index.
Yeah.
It's likely pushing into overbought territory above 70 after this massive 26% year-to-date rally. RSI measures the speed and magnitude of recent price changes.
Right.
And when it goes over 70, it usually means the stock has been bought up way too fast, the rubber band is stretched to the absolute limit, and it's due to snap back.
And that snapback potential is exactly why we have to look at the psychology of the support and resistance levels on the chart.
Let's look at those key levels. The immediate resistance is right above us at $6.80, which aligns with the recent HSBC price target. And then the 52-week high is up at $8.02.
Yep, those are the ceilings.
But if it falls, the support floor is way down at $5.78, and the psychological panic level is all the way down at $4.38. Why are those specific price levels so sticky?
Because resistance at $6.80 isn't just a random number. It represents the psychological pain point of other traders. Imagine the people who bought the stock at $6.80 months ago, right before it crashed.
Oh, they've been trapped.
Exactly. They've been holding on to massive losses, sweating bullets. Now that the price is finally climbing back up to $6.80, they aren't looking to make a profit. They are just desperate to sell and break even. That creates a massive wall of sell orders.
For retail buyers who jump in today at $6.46, thinking they're catching an undervalued breakout, are actually buying right into that wall of desperate sellers at $6.80.
That's a danger.
And if the stock hits that wall and rejects, there is essentially empty air beneath it, all the way down to $5.78, where the next group of buyers might step in.
Which is the very definition of a retail value trap. You get lured in by the fast momentum and the options frenzy, but your risk-to-reward ratio is entirely backwards. You're risking a massive drop for a very small potential gain before you hit that heavy resistance.
And if we step away from the chart and back to the fundamentals, the trap gets even deeper. Let's dig into the structural downside risks that make up the heavy bear case against this company. Because earlier, we established that they have a negative free cash flow of roughly 17 billion yuan.
Right, the cash burn is severe.
Eventually, the cash in the safe runs out. How do they keep the lights on?
Well, they issue more equity, they do secondary stock offerings.
Dilution. This is the silent killer for retail portfolios.
Yeah.
Can you walk through exactly how dilution physically destroys shareholder value, even if the company's surviving?
Let's go back to our restaurant analogy.
Okay.
You and 9 friends each own 10% of this restaurant. You each hold one of the 10 shares. But the restaurant needs cash to pay its debts. So the company creates 10 brand new shares out of thin air and sells them to new investors to raise cash. Now, there are 20 shares total. You didn't sell anything, but your one share now only represents 5% of the company instead of 10%. Your ownership, your voting power, and your claim on any future profits have just been cut in half.
And NIO has a historical reliance on doing exactly this. Whenever the cash runway gets short, they tap the equity markets.
They've done it repeatedly.
So a retail investor buys a stock today thinking they bought the absolute bottom, but a year from now, the stock price drops another 20% simply because the company inflated the share count to pay for its negative cash flow.
And we really have to place this cash burn into the current macroeconomic reality. The EV industry is not operating in a vacuum. There is a brutal, scorched earth price war happening right now in China.
Driven primarily by BYD and Tesla, who are just aggressively slashing sticker prices on their vehicles.
Yeah, because BYD and Tesla have the massive scale and, more importantly, the vertical integration to survive a war of attrition. They make their own batteries, their own parts. They can afford to lower prices and still make a profit.
While NIO is sitting on that fragile, hard-fought 13.6% gross margin.
Exactly. If the guy across the street is selling a comparable EV for thousands of dollars less, NIO has a terrible choice to make.
Right.
Do they hold their prices steady to protect that 13.6% margin, knowing they will lose massive market share and volume? Or do they slash their prices to match BYD, instantly destroying their margins and plunging that hard-won GAAP profit right back into the red?
It's a lose-lose scenario.
Yeah.
I mean, hold the line and lose customers, or cut prices and bleed cash even faster. Given that existential threat, you would think Wall Street analysts would be screaming to sell the stock and running for the exits.
Didn't think so, yeah.
But looking at the consensus data, they aren't.
The resilience of the analyst ratings is actually fascinating. We are looking at a 60% buy rating, 30% hold, and only 10% sell.
Only 10% of analysts are saying sell on a company burning 17 billion yuan a year in a price war.
Yeah.
What do they see that the balance sheet isn't showing us?
Well, they see the massive delivery growth and the product expansion strategy. The price targets reflect this optimism, ranging from Barclays' bearish low of $4 all the way up to UBS projecting a high of $8.50. The median target is sitting at $7. Wall Street is betting on the best-case recovery scenario.
So let's map out that bull case scenario. It clearly starts with volume. In Q1 2026, NIO reported deliveries hitting an impressive 83,465 units. That is an explosive 98% year-over-year increase.
And achieving a 98% increase in unit volume during an intense price war is a massive positive signal. It proves that the consumer demand for their specific technology and ecosystem, like their battery swapping stations, is highly resilient. People actually want the product.
But they aren't just selling their premium luxury models anymore. The data outlines a massive strategic pivot. They are heavily scaling their new family-oriented brand, ONVO, and their new entry-level brand, Firefly.
Yeah, and this is the critical mechanism for their survival. Historically, NIO has been a niche premium automaker, high price, lower volume. Moving down market into the entry-level segment with Firefly is a play for sheer volume.
But wait, doesn't building cheaper cars hurt their margins even more?
On a per-car basis, the margins might be thinner, sure, but it allows them to achieve true economies of scale.
How so?
When you build the Firefly, you use the same software architecture, the same supply chain relationships, and similar underlying platforms as the premium cars. You are spreading your massive research and development costs over hundreds of thousands of vehicles instead of tens of thousands.
Ah, I get it.
That scale is the only mathematical way you eventually flip negative free cash flow into positive territory. You have to outvolume your fixed costs.
And it sets them up for international expansion. I mean, you can sell an entry-level Firefly EV in European or emerging markets much easier than a $70,000 luxury SUV.
Precisely. The analysts are looking past the current short-term cash burn and projecting what the company's financials will look like when Onvo and Firefly reach full global production scale.
But the most compelling part of this bull case might not be the cars at all. It's actually an insider catalyst we found in the filings. CEO William Lai was recently granted 248 million restricted units of the stock.
That's a huge grant.
It is. But the catch is, he doesn't just get them for showing up. They are tied directly to specific, aggressive market cap and profitability targets.
And this is how you perfectly align executive incentives with shareholder survival.
It reminds me of a star quarterback signing a heavily incentivized contract. You don't get the $50 million guaranteed signing bonus up front. You only get the massive payout if you actually win the Super Bowl and throw 40 touchdowns.
Exactly.
LS has a literal multi-billion-dollar reason to ruthlessly push this stock price higher.
The market places a huge premium on a CEO with real skin in the game. When the person making the operational decisions only gets wealthy if the retail shareholders get wealthy, it instills confidence.
Right.
It tells institutional buyers that Lai will be forced to make the incredibly difficult decisions, maybe cutting bloated departments, aggressively negotiating with suppliers, or delaying tech projects just to hit those margin targets. He is financially chained to the success of the stock price.
So if we pull all of these threads together for you listening, we are really looking at two entirely different timelines acting on the same stock.
You definitely have to separate the short-term noise from the long-term mechanics. In the short term, the algorithmic momentum is driving the bus. The market is reacting to the Q4 GAAP profit breakthrough, the massive call option volume, and the potential golden cross breakout.
Right. The immediate focus is entirely on whether it can smash through that $6.80 resistance level before the upcoming Q1 2026 earnings report, which hits the wire on June 2.
Yeah, the short term is a game of momentum and avoiding the technical trap. But the long term is an existential battle.
For sure.
It is a race against the clock to scale the mass market Onvo and Firefly brands fast enough to achieve those economies of scale before the negative cash flow forces them to heavily dilute the stock again.
The Q4 profit proves the machine can work. But the balance sheet proves the machine needs a lot more fuel to survive the winter.
That's a great way to put it.
Which leaves us with this final thought to chew on. We know CEO William Lai's massive multi-billion-dollar payout requires him to hit very aggressive new profit targets. But what drastic, potentially company-altering strategic moves will he be forced to make if the relentless Tesla and BYD price wars drag NIO's margins back into the red? If his back is against the wall, what does the desperation playbook look like?
I mean, that is the ultimate unknown. When survival and billions in compensation are on the line, every option is on the table.
Definitely something to keep a very close eye on as we approach that June 2nd earnings call. Thank you for joining us on this deep dive into NIO's complex financial landscape. As a final reminder, make sure to like this video, subscribe to the channel, and drop your take in the YouTube comments right now. Are you siding with the bulls, chasing the momentum, or the bears warning of the dilution trap? We want to read your theories. We'll see you next time.